I'd like to introduce you to Suzanne Duncan, the moderator of this panel. Suzanne is the head of global research at State Street Bank. She's the author of scores of white papers and manuscripts, particularly in the area of investment management. You will see her commentary on almost every major media outlet throughout the globe. But the thing that we're most proud of is that she is a member of the Board of Advisors of our Center for Finance Law and Policy. Suzanne will introduce Shelia Bair, Jerry Corrigan, and Ray Natter.
Excellent. Well, thank you very much, Con. Thanks for the opportunity. I'm honored to be moderating a panel that really needs no introduction. We have with us today Jerry Corrigan, who is the chairman of Goldman Sachs Bank USA and the former president of the Federal Reserve Bank of New York and the Federal Reserve Bank of Minneapolis. We also have Shelia Bair, who is the former chairman of the FDIC and currently serves as a senior advisor to Pew Charitable Trust. And finally, we have Ray Natter, who is a partner at his law firm Barnett, Sivon, and Natter, and formerly served as the deputy chief counsel of the OCC. So I'd like to kick off the discussion by asking each of our panelists to provide 10 minutes. That is a very brief amount of time, 10 minutes for opening remarks, and then the remainder will be devoted to a discussion followed by a few questions from our audience. So the backdrop for this panel is the seminal paper that Jerry Corrigan penned in 1982 titled Are Banks Special? So Jerry, it of course makes sense to kick off with you, and we welcome your views.
Well, thank you very much. And thank you all for joining us today. We have a very full and I think somewhat provocative agenda over the course of the day. So I will deviate from my usual pattern, and I'll try not to be provocative. But I probably will not succeed. First of all, let me say that I have made copies of the full text of the Our Bank Special available out here someplace. And I also made available a follow-up paper that I wrote in 2010, I think it was, where Gary Stern, who succeeded me as president of the Federal Reserve Bank in Minneapolis, asked me to write a sequel in terms of how did the world look now compared to when I wrote the original piece in 1981-82. I think that I can summarize in maybe a minute and a half what the essential philosophy of the Our Bank Special essay was. And what it basically came down to was, first of all, trying to come up with a really coherent and tight definition of banking. And I deliberately did that myself without any help from anybody but myself. And essentially, the concept, of course, was straightforward in that it started out with the proposition that banks, as part of their larger role of mobilizing saving and devoting those savings to the most efficient possible uses, was directly tied to the proposition of a very tight, narrow definition of deposit taking and what that implied in terms of the lending side and the investing side of banking institutions. It seemed to me then, and it still seems to me to be the case now, that if you follow the suggestions that were made in that context, in terms of what banks were and then why they were special, it led me to the conclusion that banks, because of those special functions, should be, and largely are, unique in the sense that they are subject to the so-called federal safety net, deposit insurance, supervisory provisions, and, very importantly, access to the liquidity and payment facilities of the central bank. One of the things that irritates me still to this day is people still pay very little attention to the importance of the payment facilities of the central bank, not just in the United States, but all over the world. And that was kind of the hypothesis. And then I set out to try to put Humpty Dumpty together. And I quickly came to the conclusion that getting the definitions and the philosophy approximately right gave rise to another whole series of questions in terms of, what power should banking organizations have? How much emphasis should we put on subsidiaries of banks as opposed to subsidiaries of bank holding companies? And that list goes on. I'm not going to go into any detail. It ended up that when the thing was put together, I felt pretty good about it at the time. But I have to admit that quickly after the first version of the essay was put together, the banking system went through a pretty rough patch in the 1980s. The fact of the matter is, starting with the failure of continental Illinois, the thrift crisis, the Southwest banking crisis, the New England banking crisis, this was not a good time. And I began to ask myself the question, what did I miss? Because certainly the experience of the 80s I thought was pretty lousy. A few of you may remember, John Reed probably is someone who remembers quite well, that when we got to 1980, 81, 82, we came pretty close to a really serious situation that involved not just banks, but insurance companies, investment banks. This was turned out to be too close to call. One of the doctrines that I had left out of the original essay is a doctrine that I think is still as important today, and maybe more important, is the so-called doctrine of prompt corrective action, getting ahead of problems when they begin to emerge, as opposed to wait until it's too late. And I began to feel a little bit better that we did a pretty good job of dealing with that situation. I was surprised as we went along that a lot of people were still reading that essay. As a matter of fact, they're still reading it to this day, which is really remarkable. So what I tried to do, which I will get to very quickly here, is to revisit the question over the past 3 or 4 weeks. Are banks, as I suggested 30 years ago, still special, or have events simply outpaced us? And if you look at the period of the last decade or so, clearly between legislative changes, to say nothing of the financial crisis itself, at first blush, I think a case could be made that banks being special had run its course, that so much had changed, and the changes were so radical in many respects that the specialness of banks, as I said, has run its course. The more I thought about that, the more I came, believe it or not, to the opposite conclusion, that indeed I could make a case that the specialness of banks today is more important, not less important, when I wrote that first essay in 1981-82. And you'll maybe sad, maybe glad, I'm not sure, but I've kind of decided it's time now to write the sequel again. to revisit the thought process and the principles that were tied up in the 1982 essay. I'm not sure how long that will take, but it's going to be very difficult because while I think the principles are still essentially right, I also know that the experience of the last 30 years, with particular emphasis on the last 10 years, is going to be extremely difficult to rationalize in the current setting and looking to the future why I believe that banks still are special. The challenges that lie ahead for the banking industry and for the financial industry more generally are going to be a major subject of our discussion throughout the day today. And I look forward to listening and learning to what people have to say about that. But the bottom line of my conclusion for the day, and my 38 seconds left to finish, is I, for one, still very much believe that banks are special. I think the functions that they perform in the context of the 1982 principles are still essentially right. But the world has changed radically. And how you square the circle with 30-year-old principles and contemporary realities is not going to be easy. So thank you very much for your patience. And
thank you, Jerry. Exactly on time. Shelia, let's now hear your perspectives.
So I would agree that the banks are still special, I think, for all the reasons that Jerry articulated in his landmark paper. The three functions that he identified in that paper were transaction accounts, backup provider of liquidity, as well as the transmission belt for monetary policy. Of those three, I think the first two clearly are the most important to an effectively functioning economy. And with transaction accounts in particular, both households and businesses need to know they have a safe place where they can keep money that needs to be readily available, that will have stable value, that will be there when they need it. And banks are uniquely equipped to provide that. But we learned through many hard lessons that government intervention is necessary to provide that stability in the form of central bank lending as well as FDIC insurance. But with that, those government supports comes moral hazards, so you need an overlay of prudential regulation as well. So that is the basic framework, and I think it is still highly relevant. I think the problem is we've deviated from it. We started letting entities that were not banks and that were not in the safety net and were not subject to prudential supervision and things like capital requirements to perform banking functions. The 2008 crisis, I think, has been rightly called a run on the shadow sector, and that is what was going on. But we really don't have clarity of purpose in moving forward to try to define those functions that are essential to the economy and need to be part of the safety net from those and make sure that those entities are regulated appropriately with others who want in good times to provide those services. And of course, in good times, anything works. And so we have this muddle now. I think money market fund reform is the prime example where the cleanest solution to that, in my view, is they're not a bank, they're a mutual fund, and they should act like a mutual fund and have a floating NAV the way other mutual funds do. But there's tremendous resistance. It proved itself to be unstable during the crisis, but there's tremendous resistance to making that kind of significant change. And so we have a muddle, and I think we're going to end up with a muddle if published reports are right, with some tepid reforms, perhaps including, barring mutual fund, money market fund investors from getting their money or having to pay more. That's an easy way to stop runs, but I don't think that's really very helpful to investors, and that could be disruptive to the payment system if you have widespread gates and fees going down in a crisis. There are also other areas that are not really traditional banking functions that are now in the safety net, like clearinghouses. I must say I don't get that. Dodd-Frank opened for the first time, allowed clearinghouses to be able to access the Fed's lending facilities, but did not provide the same kind of regulation that banks get. And the oversight continues with the SEC and CFTC, which are great agencies, but woefully unfunded. And so I see the safety net expanding to areas that really are not traditional banking functions, and frankly, didn't really perform that badly. I mean, that's why we're trying to push more derivatives into centralized clearing, because they worked pretty well. But with this new source of moral hazard and underfunded regulators, I fear where that may take us. The second function, backup providers of liquidity, let's face it, the banking system ended up being a disruptor of liquidity, not a provider during the crisis. And I think that was very unfortunate. And the reason that occurred was because we had too many banks as well as shadow banks relying on short-term funding, not traditional, more stable sources of funding. They went to highly short-term funding, and then they used that to fund very risky, opaque investments that were hard for investors to value and understand their solvency, and they had very thin capital levels as well. So they ended up pulling back. And that's why we had the recession. They withdrew liquidity as opposed to performing their function of providing that liquidity in times of economic stress. So regulators, I think, recognize this and have been moving forward with tougher capital requirements, but there's still so much work. I mean, courageously, they have proposed a tougher leverage ratio. I hope we'll see that finalized soon. But in 2010, in the Basel Committee, we also agreed to capital surcharges for the largest systemic institutions. That hasn't even been proposed yet. And most of the studies I've seen, most of the banks have increased their capital levels by, say, 1% to 2%. A lot of that was through merger and acquisition activity, though. It wasn't through regulatory action. And in my view, I know people disagree with me, they're still too over-leveraged. They need more capital. And I think that is really this key to making sure that they are not liquidity disruptors when the next downturn comes, and we all know at some point it will. But the focus has been more on requiring banks to hold a lot of so-called liquid assets on their balance sheet as opposed to getting significantly higher capital levels. And I think that approach, the emphasis on that approach troubles me for a couple of reasons. One is you obviously advantage banks with large trading operations as opposed to loans, which are not liquid. And that's counterintuitive to me because it was the financial institutions with the big trading operations that I was seeing that were the most likely to get in trouble and were most in need of bailout assistance. But you also, I think regulators are making assumptions that these assets are liquid when I don't think they are liquid. And so they're putting significant haircuts on them. But will they be able to sell those assets in a crisis? Do they have enough capital to absorb the losses? I mean, that's just not clear to me. And no amount of, so-called liquid assets on their balance sheet is going to staunch a run if the market views them as insolvent. So I think, getting the capital levels up is really important, and more transparency on what's on their balance sheet as well, so investors don't panic. They will know whether Lehman's insolvent or not. They can see better what the heck they've got on their books and have a better sense of what the values are. But we didn't have that kind of transparency during the crisis. And it was the same for regulated bank holding companies like Citi. And so I think more focus on that to make sure banks in the next time will be backup providers of liquidity, not disruptors, is extremely important. Finally, on monetary policy, I would defer to Jerry and others who are much more knowledgeable on this than I, but it seems to me banks have become less relevant as a transmission belt for monetary policy. The direct market interventions have really become the tool of choice for the Fed. Whether that's a good idea or a bad idea, I've had my concerns. I've expressed them before. I don't need to go through that again, but I do think that is a significant switch in how monetary policy is performed. And again, I think history will tell whether this was the right move or not. I certainly have had my own concerns. So I would just say in conclusion that I do think banks are special, but I think the answer is to recognize that the backup providers of liquidity in times of economic and market stress, they absolutely need to have a reliable payments system. Those are really the core functions that need to be in a safety net. But the rest of it I don't think does. And I think if you give them that safety net access, especially if you give it to them without the corresponding increased regulation and capital requirements, we're asking for trouble. My view is put the bailout genie back in the bottle. Don't ratify bailouts as the tool of choice going forward. But I'm not sure I see that clarity of purpose in the reform efforts that are going on now, especially with clearinghouses. And again, money funds, it doesn't look like they're going to get fixed. So I think that's troubling and something people who care about a safe, stable banking system should also be worried about. Thank you.
Put the bailout genie back in the bottle. That's a good one. Last but certainly not least, Ray, we welcome your views on a related theme, namely preemption in the wake of Dodd-Frank.
Thank you very much. Excuse me. The subjects that are being discussed are much broader than preemption and perhaps more interesting. I will try and limit my remarks so we can get onto the discussion of these broader policy issues, which are fascinating and I think will make for a lively discussion. But let me begin by saying that I worked at the OCC for 10 years, and I'm very proud of the time I spent at that agency, and I'm very proud of the OCC and the work done by Controllers Hawk, Ludwig, Dugan, and by Acting Controller Walsh were first rate. They were terrific controllers. They made wonderful policy decisions, and they certainly contributed to the resolution of the problem when the financial crisis hit. And in that regard, I also want to compliment Shelia and Tim Geithner and Secretary Paulson and the others who I think were extremely courageous, sometimes taking actions that were needed when to be diplomatic. The statutory authority may not have been entirely clear, but they stepped up to the plate and did things that took quite a bit of courage to do. And I think we all owe a bit of gratitude to the leadership we had, both in the administration and in the regulatory agencies. One of the concerns or criticisms I would make of the era immediately following the crisis was the lack of attempts to educate the American public about what exactly was happening, what caused it, and why we needed to take extraordinary steps. And as a result, I think there's a lot of popular misunderstanding about the function of the banking system, the role of the banking system, and why allowing the banking system to collapse would have been a catastrophe for not only the United States, but the whole world. And if that type of educational effort should be made, was not made as well as it could have been made, and unless it is made, I'm afraid it could have negative implications for the policy decisions going forward. Now, I will speak briefly about preemption because this is an example of how sometimes the popular beliefs and understanding about the causes of the financial collapse do not line up with the facts. And that, speaking more broadly, we really don't have all the facts. We don't have the empirical studies. We don't have the research done. A lot of decisions that have been made and are being made are based on common understanding or misunderstanding about the causes of, and therefore, without the actual information available. It may take a while to have those studies done. They're starting to come out. There was a very good study recently by the Federal Reserve Bank of Boston, which I highly recommend. Chris Cook was the primary author of that. There's a good paper coming out of NYU by Larry White. And so the literature that is actually coming out now often disagrees with the perceptions that we had in 2008 and 2009. So preemption might be a good way of illustrating that because there was a lot of concern, and the conventional wisdom was preemption was directly related to the housing crisis, that national bank preemption allowed unscrupulous loans to be made. The facts are that, first of all, the OCC took the lead. It was the first agency, going back to Comptroller Hawk in 2000, the year 2000, when he began alerting the OCC examiners to watch out for lending standards, to tighten up on predatory practices, to look for equity stripping, to look for loans being made that were not in the best interests of consumers. And that went forward in 2003, 2004 by regulation. The OCC said that national banks cannot make a loan based on the asset value of the collateral, but had to be making loans, consumer loans, based on an analysis of the ability of the borrower to repay. And then when you look at the data shows that the overwhelming majority, just about all loans that are considered predatory, were made outside of the national banking system. And of the loans that are considered subprime, national banks had a very low percentage of those loans. Some reports, 15% of the subprime loans were originated in national banks. And those loans performed better and were less costly than subprime loans originated by others. Now, I think the proof of the effectiveness of OCC supervision, and I want to add, the other banking regulators took similar steps. So the FDIC and the Fed certainly had similar regulations in place. So when you have, if you look at bank holding companies that were originating subprime loans, they were not being originated in the depository institution. Prime example might be Countrywide. The largest originator of subprime loans had both a national bank and later a thrift. The loans were being originated in a non-bank, state-regulated affiliate at the holding company level. Now, I'm not criticizing my good friends in the state banking system because these were not banks. They were being, by state regulated, they were, at the time, there was very little authority for state banking regulators to regulate these activities. Now there is a lot of authority and we will see improvements. But at the time that the loans were being originated, it was being originated in state institutions that had very little regulatory authority. Now, why is it important to have preemption? We've heard the Comptroller state national standards. They're more effective, they're less costly, they're beneficial. But there's also an important factor involving safety and soundness. The individual states, in the name of consumer protection, can take actions which are contrary to the safe and sound operation of depository institutions. A good example was in the early 90s, when interest rates, as you recall, were 13, 14% for home mortgage. You had states which prohibited the enforcement of clauses saying that a mortgage is due and payable when the home is sold. So depository institutions, primarily thrift institutions, had 30-year mortgages on their books, thinking they would have an average life of 7 years, which is statistically how often a home would turn over, funded by short-term deposits. When you prohibited those loans in the name of consumer protection from being called when the house was sold, you transformed those loans into 30-year, low-yielding assets being funded by high-cost deposits, hundreds of millions, which now would be billions, of losses were caused by that. This is just one example. I have certainly give you many examples where you've got state laws designed to protect particular consumers in particular states without the strong ability to have national laws that may seem to hurt one group of consumers, but actually are necessary to protect national banks and national banking system. In my 1 minute that's left, I would conclude by saying consumer protection is important. We now have a CFPB to issue national standards on consumer protection. It's necessary. There certainly were preemption rules which people can disagree with, but the standards and the ability to preempt state law is critical to the National Banking Act and important to safe and sound operation of all depository institutions.
Thank you. So you've each listened to one another's remarks. What did you agree with and what did you disagree with? And Ray, I'll put you on the spot.
Okay.
Answer that one first.
Well, I'd be glad to take a stab at that. With respect to Jerry's remarks, I agreed with very much almost everything he said. I think banks are special. I think they serve a unique function, which is no other financial intermediary can provide some of the services that banks provide, including transferring long-term assets into short-term liabilities, which is critical to our system. The one point, and it was really sort of an aside, which I would disagree with, was his reference to the benefits of prompt corrective action. I think prompt corrective action is certainly a worthwhile goal, but I don't think it's a realistic provision. In FIDICIA, which I worked on the Senate Banking Committee, so in a way it was criticizing something that I was partially an author of, the prompt corrective action requires acquiring a bank when its capital is 2%. When a bank fails, somewhere between 20, more typically closer to 40% of its asset value is wiped out by seizing that institution. If you were to seize institutions when they had 2% capital, the losses would be put on the FDIC system if they could stand it. And we've seen in the crisis institutions that, if were marked to market, probably would not have met the 2% test. But they were not closed. They were able to be revived at a tremendous savings to the American economy. So the theory of prompt corrective action is great. I don't think it works in practice. With respect to Shelia, I agreed with much of what she said, and I respect her views tremendously. I agree that it was a run on the banks. I disagree with her solution, and I disagree with the philosophy that to make banks a source of liquidity, we have to make them hold liquid assets. In 1913, prior to 1913, there was a run on the banking system. We did not have a Federal Reserve. We had a bank called J.P. Morgan in New York City, which got together the other money center banks and said, we need to provide liquidity to the banks in this country to prevent a run. And they provided that liquidity. And out of that experience, we developed the Federal Reserve System. And one of the primary purposes of the Federal Reserve System is to provide liquidity when you've got a panic in the marketplace. When assets are good, but you have a panic causing a run, the Federal Reserve and the Federal Home Loan Bank System are there to provide liquidity. If you say that banks have to hold $2 trillion in government bonds in order to provide the liquidity in case of an emergency, you are taking that fund out of the economy. And since there's leverage, that $2 trillion could be $5-6 trillion of lending. And you're not really helping safety and soundness, because the way the proposal is, you are going to be encouraging banks to go holding long-term treasury bonds. And if there's a liquidity crisis and interest rates are up, those bonds are going to have to take a big haircut. And you're encouraging banks to acquire foreign debt. And under the proposal, Italian debt and Italian debt and Spanish debt and Portuguese debt and French debt all count 100% towards liquidity, but you get a much bigger return. So a rational institution is going to say, rather than holding short-term treasury debt to meet this requirement, I'm going to either go long on treasuries and I'm going to mix it in with some foreign debt, and therefore you're creating the next crisis, in my view.
That's great. So Shelia, maybe you can go next. What did you agree with? What did you disagree with?
So let me just make a few comments on Ray's comments. I think maybe you misunderstood what I was saying about the liquidity rules. I don't like the emphasis on requiring banks to hold a lot of liquid assets. God forbid we might agree on that. No, I think capital, the best protection against a run on any bank is to make sure they stay solvent, and you do that with higher capital requirements. I think you need more transparency too, so investors can get a better sense of whether the financial institution is solvent, and there's been very little focus on greater transparency for these large, complex financial institutions and then making them reduce their reliance on short-term debt. And the market has done that a bit. You've seen short-term financing come down significantly, and that's a good trend. But no, I don't like that. I think it does create some very funny incentives and again, advantages banks with large trading books and disadvantages banks with a lot of loans, because those loans aren't viewed as liquid assets. So on that one, I'm not sure we do disagree. On PCA, it's a perfect no, but I will tell you, as the former chair of the entity that was responsible for resolving these failed institutions, having some type of statutorily prescribed process to reach the trigger point was extremely helpful to us, because it is never a thing to close a bank. And there's a lot of pressure from politicians, from stakeholders, sometimes from regulators. They don't want to, the primary regulator, they don't want to own up to the fact that the bank's in trouble. So having some type of statutorily prescribed process, I thought was helpful. The loss rates you cite were significant. I don't think they were quite as high as the numbers that you were articulating, but that's the problem when you resolve a bank. You're by definition in times of market distress, so you're not going to get very good pricing. I think something that could make PCA work better is better methodologies around reserving and determining when you hit that 2% trigger point. I think banks, examiners were saying perhaps months before we thought we got to that 2%, that their capital had declined to that level. So I think there are ways to improve PCA, but I do think you need some type of objective method that, especially the closing entity like the FDIC, can point to and say, sorry, our hands are tied by statute, this institution has to be closed. Because the longer you wait, and that was certainly the lesson of the S&L crisis, like bankers say, your first loss is your best loss, and when they're cooked, and you need to move ahead. On preemption, we're just going to disagree on that. I think in the area of consumer protection, preempting states and their ability to protect their own citizens, just as a matter of policy, is ill-advised. I don't think it's, I do think you're right, the OCC did have an ability to repay supervisory standard. Wasn't clear how that was applied to these adjustable rate mortgages. I remember having some very robust discussions with other regulators about whether you underwrite at the fully indexed rate. So is the ability to repay just the first 2 or 3 years of those hideous hybrid arms, or whether we're talking about is it ability to repay throughout the life of the loan, or at least for several years ahead and through the reset period. Also, national banks for funding these loans. I think those standards apply to mortgage originations, but not to the loans that the national banks and others were funding. So that was another, I think, hole in the approach we're trying to take. But just more importantly, there was some really ugly stuff going on in the states. They were right. They were right to want to move forward. And I think, just more generally, you shouldn't interfere with states' desire to protect their own citizens. And there are market factors that can temper the state's ability to go too far. I mean, the business will leave, and the states know that, so they try to calibrate it right. But state experimentation with state consumer laws can also be very helpful to national regulators, because they are laboratories, and important laboratories. So I don't agree with that decision. I regret that the OCC did that. I think it hurt its reputation. I think it did result in many states consumers not having the protections they should have had. We'll just have to agree to disagree on that.
Well, agree.
Jerry, what are your thoughts on Sheila and Ray's comments?
I guess 2 things I want to comment on briefly. First, I'm not prepared to accept the suggestion that prompt corrective action can't work. In fact, I would argue that based on the experience of 1980 to 1982, it worked quite well. And indeed, because it worked quite well, we were able to get through an extraordinarily difficult situation that was involved banks, investment banks, insurance companies, domestically and internationally. And that was not an accident, that we got through that without spending 1 nickel of taxpayer money. That's what it's all about. And if you contrast that experience with the fall of 2007, where industry leaders, central banking leaders, and other leaders were basically saying, don't worry, the mortgage thing is manageable. Well, that was obviously quite wrong, to put it mildly. So, and beyond that, if we really are committed to the proposition that we can fix too big to fail through resolution authority and other related techniques, by definition, resolution authority, orderly wind down of seriously troubled financial institutions, seems to me to be bound together with a framework of much more prompt corrective action. So I understand some of the nuances that you were referring to, and they're valid. I mean, to make it work is not going to be easy, but we've got to get there. The second thing, Shelia, I would like to clarify a little bit if I can, and that is this liquidity concept. Let me say, first of all, that I believe that on a very, very short list of enhancements to the regulatory agenda post-crisis, that one of the most important steps in that process has been putting into place, through the Basel Committee, side-by-side standards of capital adequacy and liquidity adequacy. And these two things, capital and liquidity, these are a single discipline. These are not opposite sides of a same coin. That's a unified approach. And when we think of that, we have to also keep in mind that the definitions of liquidity that are being used in that context speak about unencumbered liquidity. It's not repoed, it's unencumbered. And if you look at the way the framework for this single discipline of liquidity and capital adequacy is playing out, it is not unusual to find emerging situations where the amount of unencumbered liquidity is now often well up into the high teens as a percentage of total assets and liabilities of major banks. 17, 18% is no longer unusual, and again, it's unencumbered. So I think that your concern, Shelia, about other aspects of the liquidity world remain very important. I do think we've also made progress in terms of reducing, through a variety of devices, the absolute amount and the relative amount of other forms of liquidity, including repos and all of those things. So I think we have made and are making a lot of progress there, but that single discipline of capital adequacy and liquidity adequacy, I think when we look back 10 years from now or something, unless I'm dead wrong, which is possible, I think we may conclude that this is one of the best things we've done. Keeping in mind that at the end of the day, all of us know this, the straw that breaks the camel's back with regard to failing institutions typically is not capital, it's liquidity. It runs on banks and things like that, which now are just pushing a button on a computer. So again, I think that if we get that right, and frankly, if we get prompt corrective action at least close to right, those two things alone, I think, would have a very, very beneficial effect, not just on special banks, but on other financial intermediaries as well.
Well, I agree with the premise that prompt corrective action, the statute, is a very useful supervisory tool and very effective. I disagree that prompt corrective action is a method of protecting the banking system in times of financial collapse. So prompt corrective action was not a tool that was helpful in preventing or in dealing with the financial collapse. But more fundamentally, on the liquidity, there's two ways that one can look at the banking system. You could take it from the perspective of, I really want a system that is going to be 100% safe and not have failures. And taking that to its extreme, you have a system that has 100% liquid assets. You don't have to worry about runs. It has very high capital ratios. The trouble with that type of bank, which will never fail, is that it will never loan money to anybody. So that for every, it's a seesaw, it's a balance. If you want to have an absolutely safe and sound banking system, you're going to have a system that is not working to provide credit to the economy. On the other hand, if you don't have enough safety and soundness and prudential regulations, you'll have risky institutions. But banks, by their nature, are supposed to be risky. Making a commercial loan, or as we saw, a residential loan, can be a very risky endeavor. Banks are designed to take risks, designed to leverage their capital base, designed to perform an intermediation service. The liquidity rules that are being proposed not only are excessive in my view, but are counterproductive. Why would a rule say that you can invest 100% in US Treasuries or Italian debt, but you can't invest and have liquidity credit for a money market mutual fund that can only invest in US governments? There's got to be some rationality and some balance in what we do, and the emphasis that safety and soundness is always going to be the predominant regulatory goal is not going to work in the long run.
So I would just say, I agree with Jerry. I think, again, I want to clarify what I was saying on liquidity. I think it's extremely helpful. The Basel Committee looked at liquidity and capital side by side. My only point is I think there should be more emphasis on capital and more emphasis on reducing their reliance on short-term funding, because the centerpiece seems to be putting more liquid assets on. And why not just raise the reserve requirements? Someday somebody will explain to me why the Fed never wants to tamper with the reserve requirements. But if that's the thing that's the most liquid, is their excess reserves. So some of this stuff they're doing is counterintuitive, but I don't want to suggest. I think it's very good. We're moving forward liquidity rules, but this emphasis on having a lot of sovereign debt and other types of supposedly liquid assets, which I don't think will be always liquid in a crisis, is what worries me.
We may have a chance later to talk about Fed policy a little bit, but just one footnote that I think is directly relevant to the point you're making, just so the audience understands it. If you look at the balance sheet of the Fed today, or yesterday, or last week, or whatever, what you find is there is something in the order of magnitude of $2+ trillion of bank deposits in the Federal Reserve banks. $2 trillion sitting there with a return on the excess reserve of 12 basis points or something like that. That, by the way, is not wholly independent of my suggestion in the essay that banks are part of the transmission mechanism for monetary policy. And let me tell you, the day is going to come, and you and I have talked about this on other occasions, when we're going to have to figure out what the hell we're going to do with that $2 trillion. That's not going to be easy.
No, it's not.
So on the topic of are banks still special, here is a two-part question. How has the role of banks evolved over the last 30 years, and has bank supervision and risk management kept pace with this evolution? Anyone can have a crack.
I can't resist.
Go for it. Of course, Jerry.
First of all, by any standard that you can think of, including looking back at history for multiple millenniums, the last 30 years or so have been pretty damn tough in terms of the incidence of serious, if not systemic, financial shocks, both here in the United States and around the world. And if you do, as I have, some comparisons, you look, for example, at the number of serious financial crises that occurred in the 30 years leading up to the panic of 1907. The fact of the matter is we've had more in the last 30 years than they had in the 30 years leading up to the panic of 2007, which, by the way, it was that panic that ultimately created the Federal Reserve. So it's been a rough go. One of the things that nags at me is the following. Did we do such a good job of managing all these crises that we created a false sense of security for market participants and others that we'd always be able to pull a rabbit out of a hat until 2007 and 2008. I guess I'm not smart enough to know the answer to that question, but it's something that nags at me a lot. And I think that as we continue to work to the future with enhancements to the regulatory policies and practices, getting too big to fail under control on other things, we've got to have a much more creative framework of thinking. People love to talk about contagion risk or systemic risk. Well, the fact of the matter is that it is extremely difficult to anticipate in advance the specific events that produce contagion risk and systemic risk. It's very hard to do that. In fact, our track record of achieving that is pretty damn low. And so we think about that. So, what a lot of people say, well, they fill up a room with mathematicians and statisticians and models, and they start playing games with these things. Well, my instinct tells me that if we want to understand more about systemic risk and contagion, we ought to leave the models in the closet. And we ought to get some very smart people engaging in aggressive brainstorming sessions, not quantitative studies, not R-squares and all that nonsense, just aggressive thinking. How do these things happen? What are the triggers? Why do we miss them? Now, even when we get better at that, we're never going to be perfect. But I do think that those thoughts are extremely important in terms of our collective ability to come out of the mess of certainly the last 5 or 6 years, but even the last 30 years, with a system that is safer and sounder, a system that is able to absorb adversity, but manage adversity at the same time. And that's not going to be easy.
Yeah, this
But-
industry loves models.
Yeah, well,
We don't like to put them in the closet.
well, I think most of them belong in the closet, to tell you the truth.
Point taken.
So anyway, that's a partial answer to your question.
Sheila, Ray, what are your
Yeah,
thoughts on
well, I'm with you on models. I mean, there was an over-reliance on models prior to the crisis. There continues to be a lot of, and I'm sorry, with the Basel II advanced approaches, which we're still implementing, we encourage that. Models are one bit of risk, one bit of your toolkit for your risk management.
I understand.
Yeah, no, I know, but you got to use judgment. And the models are spewing that all these mortgages were low risk. They're based on historical data that had nothing to do with the kinds of mortgages that were being originated in the lead up to the crisis. So if you don't have some human judgment in there, you kind of a system run amok, and that is what we had prior to the crisis. I think, obviously the industry, technology has made markets more volatile, reaction times quicker, and that's just reality. That's life. We just have to live with that. But I think there are lots of things that we can still do and didn't do prior to the crisis to reduce the risk of stress and volatility, at least in the banking system, which we want to be stable. I do think the increased concentration of the industry, the emergence of very, very large financial institutions with implied too big to fail status did create prior to the crisis and continues to create moral hazard. I will say it again, I wanted bondholders to take some of the risk of loss. When we were having these, I kept saying, well, there is no insurance program for bondholders, and we're haircutting uninsured depositors, and PIMCO and BlackRock are, they're just fine. So, and no offense to them, but that just wasn't right. And I think, but clearly the bondholders generally had, or the regulators felt, that there was zero risk tolerance to taking even, we suggested 10%, make them take 10%. Couldn't even do that. So what kind of a system is that? But they're big, sophisticated. They can pay people a lot of money to look at bank balance sheets, to push bank management, to exert market discipline over risk taking. And regulators need that. Regulators cannot do it all themselves. But again, I fear that we're going to the opposite direction. We're giving up on market discipline and think we can replace that discipline with more robust supervisory presence. And I'm all for a robust supervisory presence, but I just don't think that is going to do the trick. So, we need more market discipline, and we need bondholders to clearly understand they're on the hook as well. Any unsecured creditor is on the hook. And if we could get to that stage, I think actually the market would correct in terms of forcing some of these institutions to downsize, because if they knew they were going to be at risk, not the Fed, not the taxpayer, they would do their homework a little better and be a little more cautious before investing in them. So.
Well, I basically agree with what I heard, but I have a slightly different aspect to it. When I began my remarks, I said that we really don't understand what caused the crisis. And the empirical data and information is just starting to come out. My concern is that the regulatory pendulum has swung to such an extent to being prescriptive that we don't know if it's the right answer. We don't know what it's going to do in terms of slowing the economy or preventing growth. And we don't know what it's going to do in terms of being the cause of the next crisis. And let me use as an example, the Basel risk-based capital placed tremendous emphasis on and rewards for financial institutions to acquire mortgage-backed securities. It was a much less capital standard.
Mortgage-backed securities.
So there are financial institutions that would originate mortgages, sell them, create a mortgage-backed security, and buy back that security with the same mortgages they originated. They got 1/5 the capital charge that a regular loan would have on their books, and depending on or slightly less for mortgages. Secondly, any examiner who looked at a bank in 2004, 2005, and saw a concentration in AAA rated mortgage-backed securities was probably going to complement the management of that bank and say this is a very well-run organization. So you can go all the way to what you think is a safe and sound operation today, but we don't know, and you're absolutely correct. We have no idea of knowing what the next bubble is going to be. Is it going to be stocks? Is it going to be farmland in the Midwest? Is it going to be Bitcoins? All three? We don't know. But if we tamper down investment in everything that could possibly be a bubble, first of all, it's not going to be possible politically. And second of all, we're going to wind up hurting the country in the process. Robust capital, sufficient liquidity, stress tests all make sense. But there has to be a balance too.
Well, let's talk about a topic that each of you briefly touched on anyway, but the shadow system. So, three-part question here. Given that some, if not many, financial activities are moving into the shadow system, how special is the shadow system in and of itself? What steps can be taken to mitigate the effects of potential risks? And then finally, probably my favorite question in this section, are there segments of the shadow system for which the risks outweigh the benefit to the financial system? Anyone who's interested in starting up a hedge fund, pay attention to that last question.
Let me respond first here. First of all, as some of you may know, I recently put together a think piece on the shadow banking system and presented that to their group of 30 a couple of months ago. That think piece is available on the Goldman Sachs website for anybody who wants to take a look at it. But I would make the following observations. First, this was one of the most difficult things I've set out to put together by myself, and I'm very old-fashioned. I do this stuff by myself. It's very, very complex. And I would just make two quick observations. First of all, one of the complexities arises from the fact that the term that we all use about shadow banking is wrong. Yeah. Because most of what is in the shadows is not banking, quite to the contrary. Similarly, my experience in doing my work or my research on this was as follows. That the hypothesis that has a lot of support is that the problem with the shadow banking or shadow financial system, whatever you call it, is a one-way street. Stuff going from the traditional banking and financial system to the shadow banking system. Based on my work, that does not appear to me to be right. It's very much a two-way street, not a one-way street. And if people get themselves seduced into thinking that they're going to get their arms around this with the hypothesis of a one-way street, they're going to be very disappointed. It is complex, it is big. On size, just to give you one example, and it's very hard to put this together, but you can get access to some useful data in the Fed's flow of funds data, which compiles liability levels for various classes of institutions, both the core system and the shadow system. And if you look at that data, one of the really kind of shocking things is that in 2008, based on those data, the size of the shadow system was 20 trillion, give or take. Whereas the size of the core system was 14.7 trillion. A $5 trillion difference in 2008. By the middle of last year, 2013, the thing had reversed itself. The size of the shadow system had shrunk from 20 trillion back to 15 trillion. And the size of the core system was now 15.7 trillion. Needless to say, you know, when we're talking about trillions, this is not small change. And I did put together some ideas about ways in which we can better get our arms around this thing. And I would want to make it clear in the paper, which you can get on the website, the work that's being done by the Financial Stability Board, which, as you know, is the cousin of the Basel Committee, and the work particularly I want to acknowledge that is being done by the Fed, and especially my old colleagues at 33 Liberty Street in New York, is really quite impressive. Progress really is being made in getting to better understand this. And there are specific initiatives of the risk management vintage. One of the things that I made what I thought was a pretty good argument for in this space was the financial infrastructure stuff, including settlement systems and all that, because right now, when you move away from probably the 5 or 6 or 8 or 9 best managed clearing systems, there are now dozens of them around the world. And I suspect that in many cases, the discipline that's being applied to risk control and risk management for some of those clearinghouses and related organizations probably is not what it should be. And I suggested, for example, that for all of those mechanisms, there should be, among other things, a minimal standards whereby using stress tests and related techniques, we should have a standard that would say that any one of those organizations, any place in the world, should, among other things, have the capacity that on a given business day, they could survive the simultaneous default of their 2 or 3 largest participants. So that's pretty draconian stuff. But I think it is symptomatic of the fact that we've got a lot of work to do to get our arms thoroughly around the shadow system, keeping in mind, above all else, that it is, in my judgment, a two-way street.
Yeah, I would agree with that. I think the Dodd-Frank tried to deal with issues associated, there are basically 2 things. Under Title I, it gave regulators the ability to designate institutions as systemic, that are not outside the traditional banking sector. The AIG type model problem, that so-called Title I designations, and they are brought into enhanced supervision by the Fed. Then under Title VIII, there's also a methodology for FSOC to make recommendations to individual agencies on systemic activities, and that's, for instance, money fund reform. This is one area where the FSOC has identified this as a systemic problem and asked the SEC to address it. So my view, a lot of this is more activity than institution-oriented. My sense is, you know, if a institution is viewed as unable to fail in a traditional bankruptcy without systemic disruptions, the best answer is to make them downsize until they can be, you know, resolved in a bankruptcy process. I think the Fed's doing great work. They got a lot on their plate already, and to just move more and more, just kind of accept their business and their systemic ramifications and put them under Fed supervision under Title I is not the right solution. I also think that a lot of the issues, for instance, the Office of Financial Research created quite a brouhaha recently and a report it did identifying some issues that it viewed as potential systemic problems with the asset management industry. There was a big overreaction, I think, to that report. But I do think the issues that they identified, if they need to be addressed, should be through activity regulation and mostly by the SEC. But then again, that requires the agency of jurisdiction to move forward and get ahead of these types of problems. So there are mechanisms to deal with the shadow sector based on the lessons we learned in Dodd-Frank. I think they can work if they're used appropriately. The other thing I would say, though, about the shadow sector is, the shadow sector works great in good times, and in bad times, it kind of goes away. And that's why, again, we need that well-regulated banking system that has safety net programs that will keep it functioning and lending in the real economy when those inevitable pullbacks occur. And I do worry, peer-to-peer lending, I think, is maybe one small example of where you're having a separate mechanism now for making loans, consumer, and now where they're getting into small business loans in a venue that is quite lightly regulated, certainly compared to a bank or a community bank. And so the competition is nice, and I like, there's been a problem with credit availability, so I like the fact that they're getting more credit out there at lower cost, but how much of that is because they've developed a better mousetrap, and how of it is just regulatory arbitrage? They don't have the same regulatory restrictions. And as much as I'm happy for borrowers who've had good experience with those platforms, we know in a downturn, they're going to disappear. Once investors start seeing losses on those loans, they're not going to want to, go to that platform and put their money in to make loans anymore. And hopefully you'll have a robust banking sector, and particularly the community banking sector, which does more in that small business space, will still be there. So I do think not just systemic stability, but also regulatory arbitrage has to very much be in the focus of regulators when they see these new types of mechanisms outside the traditional banking sector develop. And I think this is one area with the Consumer Bureau, I think, maybe with some ability to repay standards and other better disclosures could be helpful. But we want to make sure that, that the shadow sector doesn't so cannibalize the regulated sector in the good times. Everything works in the good times. So in the bad times, we have a weakened banking sector.
Ray, do you have any thoughts?
I'm not sure what the term shadow banking system means, and my concern is that if it means everything that's not regulated by a federal banking agency is the shadow banking system, I think it would be a mistake to try and bring all these institutions into that system. And therefore, I kind of like very much what Shelia said, which is to try and identify those institutions that the failure would cause a systemic problem, rather than simply say we need to regulate the shadow banking system, because I don't think that is necessary, and I don't think it would be productive to say you have to be subject to federal supervision, even if you're small or not systemically important. I also agree with Shelia that there could be regulatory arbitrage, which is unfortunate, but I don't think the solution is to impose the same regulatory regime on non-regulated institutions, because there are certain regulatory advantages to being in the safety net, which give banks and other regulated entities a competitive advantage. So it might even out.
So let's shift gears. Each of you have touched on this topic as well, but asset bubbles. So over the last 50 years, virtually every financial crisis has been associated with asset price bubbles, as we all know. So how can we distinguish between asset bubbles that pose systemic risk and those that do not, such as the dot-com bubble of year 2000?
Well, it's common to say nobody knows when there's an asset bubble, and I don't buy that. I think it's very hard to know when it's going to pop. But I think, anybody who didn't think there was a housing bubble prior to the crisis was just my mother saw it. She would comment about it. I mean, for heaven's sake, so let's have some common sense here. I think there are some things regulators can and should do to make sure that government actions don't further asset bubbles. One is, I think, more robust regulation that requires loans to be based on ability to repay, that you know, if you're lending to a business or a household, they've got actually income where they can pay back the loan. You're not just making a loan based on the idea that the asset is going to appreciate. We got into that during the crisis when people were routinely getting loans, and granted this is being done by non-banks without having to document that they could pay. Well, of course that's going to, you know, inflate prices. If you disassociate the price of the house from whether somebody can actually afford it, you're going to have a very increased demand and unsustainable prices building. That's exactly what we had. I think leverage is another way to make sure that bubbles don't get out of hand, and not just capital requirements for regulated banks, but also looking at the kind of leverage that the people they're lending to. You know, and I applaud the OCC for its leadership on this leveraged loan guidance. That's absolutely the type of thing that regulators need to do, especially in these, you know, this very prolonged period of accommodative monetary policy. And yes, I do think that monetary policy does contribute to asset bubbles or creates the risk of asset bubbles. So I think it's very hard. I don't think it's hard to call it. I think it's hard to know when it's going to turn. And by definition, asset bubbles reflect groupthink. Everybody thinks it's going to keep going, right? And so knowing when it's going to turn is very difficult, and telling people, you know, stop the madness. You know, Chuck Prince's favorite statement, you know, when the music's still playing, you got to keep dancing. You know, that kind of groupthink dynamic is something regulators have to defend against. But I do think some of the things we're seeing now with the tougher capital requirements, the leveraged loan guidance, will help constrain some of the, you know, the silliness that I see, and I think a lot of others see right now emerging in the markets.
I agree partially that a lot of people recognize asset bubbles, but I think the practical matter is that when you're in the middle of an asset bubble, it's almost impossible to stop it. And let me illustrate that with just a few examples. In 2006, the regulators issued relatively modest guidance to try and tamp down commercial real estate lending. And they got hauled before Congress and were lambasted in public to the extent that one of the regulators disowned the guidance right in that hearing. There was attempts to rein in Freddie Mac, arguing that they were undercapitalized. In 2004, we saw Nobel Prize-winning economists and very prominent professors write papers saying there would be one chance in 500,000 that Fannie Mae could ever become undercapitalized or insolvent. You saw in Comptroller Clark, when he tried to rein in commercial real estate lending again, which was perennial bubble, he became the regulator from hell. That was what he was called, and he was not allowed his confirmation hearing. He was not allowed to have a second term as controller because he tried to tamp down spending. It happens over and over again. When you're in the middle of a bubble, if you try and tamp down the credit, you're going to be accused of being the regulator from hell. You're going to be accused of hurting the economy. You're going to be accused of preventing disadvantaged people from obtaining a house, et cetera, et cetera. Right before the bubble, the House passed legislation called the No Down Payment Mortgage Loan Bill. Okay? Now, what would have happened in 2005 or 2006 if the agencies had said, we're going to tell our banks they can't buy mortgage-backed securities, because that's where the losses were in the banking system. It wasn't in originating loans, it was in buying the loans that the banks lost the money. And if the regulators had come in and said banks and bank holding companies can't buy mortgage-backed securities, I think the reaction would have been very, very harsh on the agencies.
Yeah, well, I would say that I know if the argument is forget it because regulators are going to get too much political pressure, I just don't buy that. I mean, that's why we have good, strong people in these regulatory jobs. That's why they have independence. That's why they have term protections. That is their job, and they need to do their job. And just to throw your hands up and say, we're going to let the craziness go on again because Congress is going to whack us if we don't. I just don't buy that.
Well,
You know, it's just, I agree the political pressure is terrible, but you know, there was a lot of pushback on the leveraged loan guidance, but other people defended it and it died down, you know, and you guys are still implementing it, right? So I don't, you know, I think you can do it. I think, you know, again, we've got much tougher leverage ratios as part of the Basel Committee's work, and the Fed and the OCC and the FDIC moving forward. A lot of support for that. I hope to see that finalized soon. Pushback on that too, but I think the regulators are going to have the courage to move ahead, and that's exactly the kind of thing they need to do, because risks are building again in the system.
Sorry.
All right, no, sorry.
Let me just respond briefly, because first of all, I didn't say throw up your hands and do nothing, and I think, I mean, I agree with you that regulators need to do something, and I think appropriate capital standards, appropriate liquidity, appropriate supervision is part of the solution. But it's also not just hearings that I'm talking about. I'm talking about in 2008, when just about everybody knew we had a problem, Congress passed legislation, which regulators can't ignore, directing the Federal Housing Finance Agency to ensure that Fannie and Freddie led the nation in providing home mortgages to very low and moderate income people, created standards that they would have to meet with guidelines, and directed Federal Housing Finance Agency to encourage the use of innovative mortgage products. This is statute. In the 80s, regulatory forbearance for agricultural loans was put in the law. So there are other examples. Regulatory capital for commercial real estate loans was directed to be given 50% risk weighting when the loans were securitized, even though the agencies thought 100% was more appropriate. It's in the law. You can't simply say that the regulators can put up a brave face and stare down Congress and nothing will happen. And if they're wrong, and if there wasn't a bubble, then they're going to be responsible for causing harm to the economy. So it's not quite as easy as that.
Well, no, it's not easy. And I was at the head of the FDIC for 5 years, and I took a lot of that flack. But I think one thing the regulators need to do more of that they don't is be public. I'm sorry. I know people disagree with my engagement with the media, but get out there and explain what you're doing and why you're doing it. Because if you're quiet about it, the people who don't like it have a lot of political influence and a lot of deep pockets. You've got to get out there in the public domain and explain what you're doing and why you're doing it. If you can't explain what you're doing and the public benefit of it, then maybe you should rethink it. But I do think there are tools that need to be used more aggressively. Believe me, I quite sympathize, and I wish Congress would just stand down and get out of it, because sometimes they're a positive influence, but I'm sorry, most of the time they're not. They're a negative influence. So not the regulators are perfect, and there's a legitimate role for congressional oversight, but that should be done through structured oversight hearings, not letters signed by 200 members of Congress telling them to stand down on a rule or whatever. I don't think they're the people with the technical expertise. They're the ones that go through the comment letters. And have that's why they have these jobs, to make these kinds of decisions, and Congress doesn't have the same expertise. So I think it's regrettable, and I hear absolutely what you're saying, but I do think there are tools to push back, and they need to be used.
It's hard to go to the public and say to the people who are buying houses and intending to flip them that we're going to take away your credit because we don't think buying a home is a good idea.
I think there'd been a lot of political, for the flippers, I think there would have been a lot of political support to crack down, which maybe...
now there is, but not back when...
So Jerry, what are your thoughts on asset bubbles?
The public basically thinks, we all know people who speculated in houses in the middle of it and thought they were doing the right thing. And it made sense if you believed in the bubble. And I don't think you can go to the press and say, we're going to take away this opportunity to have economic advancement.
Just one more thing. There are other countries, Canada and Australia come to mind, that did. They ratcheted up down payment requirements. So there were things that could have been done that weren't done.
Absolutely. And those are two countries, but there are probably half a dozen that I know of that essentially did exactly that, and it worked.
And it worked. Is that they avoided it, and we did.
So in the interest of time, a final closing question, and then we can take questions from the audience. So based on what we've discussed this morning, what is the one recommendation you would give to each of the following participants? The government, financial services providers, and consumers, and give sort of a short, snappy response to that question if you can.
You want me to go?
Sure.
Well, on the government, balance the budget. Simple.
There you go.
And one of the reasons why balancing the budget is so important is because that would give us more room to finance private investment. And if you want to get the economy back on track, one of the things that is going to have to happen is more private investment. So that's that one. Financial service providers, which I kind of tend to put regulators in that same category because we're all in the same boat. I think that perhaps especially though for financial service providers, with all the things that are being done, revisiting models, cutting expenses, building new regulatory frameworks, lots of stuff going on. All of that is very good. But what I would like to see on top of all that good stuff is more attention within financial institutions of all kinds, more attention placed on effective governance, values, and culture. Ultimately, those are the things that are going to provide the glue that really, really, really makes banks special, and in fact would make other forms of financial institutions also special. With regard to consumers, et cetera, one of the things I would love to see is for payday lenders to disappear off the face of the earth. And within that framework, to provide much more stimulus and emphasis within the regulatory community and the banking community for outreach programs that really do make progress in reaching out with banking services to low-income and other members of our society who could use some help and could use some education to begin in a really effective way to put that nightmare behind us. And then finally, which gets back to the bubbles questions, greater transparency in terms of things that really matter. You know, one of the things that's all over the place, including in the mortgage space, but it's not limited to that, is the lack of transparency. One of the things that it's much too widespread is what I like to call embedded leverage. And embedded leverage is one of the things that grows out of derivatives and other highly structured complex financial products. We've got to do a better job within the industry and within the regulatory community of trying to get much more effective disclosure, particularly as it surrounds that concept of embedded leverage. That was probably too long.
No worries. We've still got time. Shelia.
So for government, yeah, I think getting our fiscal house in order, looking to fiscal policy for growth, taking the burden off the Fed. I think, you know, monetary policy can only accomplish so much. We need, more infrastructure spending. I think you can do that in a way that's fiscally responsible. Fundamental tax reform. Those are the kinds of discussions we need to be having. We need fiscal policy to get more robust growth in our economy. The Fed can't do it. And I wish Congress, with all the problems we've had with unemployment, why there's not a greater focus on jobs and growing this economy. I don't know, but I think that's benefit for everybody, including the banking sector, to get this economy going again in a way that we have been used to in the past. For financial service providers, I think, think for the long term. Think in terms of long-term customer relationships. Think of making money by providing real value, not, quick bucks or hidden fees or, selling esoteric instruments or constructing complicated derivatives that people don't really understand what they're buying. Get back to customer service, whether it's a business or a household. Serve them, provide them good value, and longer term, that is going to make your institution more sustainable and more profitable. For consumers, I think they need to, a couple things. Consumers as voters, I think they need to get more engaged in financial reform to combat some of the issues and pushback regulators get when they try to institute unpopular reforms with the industry. I think we need more of a counterweight from the Main Street folks. So they need to get more interested and involved in and put some counter-political pressure. As consumers of financial products, it's age-old advice, but know what you're getting. I think the Consumer Bureau is helpful in terms of getting better disclosures and encouraging the industry to develop more simpler products that are easier to understand and imposing some consequences to them if they do provide things where the fees are hidden or potentially abusive. But consumers also need to be prepared to protect themselves. And so know what you're getting. And if you're unhappy, go someplace else. There's a lot of stickiness with customer relationships in financial institutions. And we probably do make it too hard to change account relationships. I'm not just talking about banks, I'm talking about brokerages as well. But move. And if the regulators, this is another thing the Consumer Bureau might think about, making it easier to move those transactions when you feel like you've not been well treated by your financial institution. That is another kind of market discipline that I think would be helpful in improving the sector.
Well, I certainly agree with the comments that I've heard so far. So I'm just going to add my thoughts, which should be viewed as in addition to, not alternatives to, the recommendations. I think the government should start to think about long-term policy and not short-term political gain. It's too much, in my view, of playing to get the next headline in tomorrow's paper, and they really need to think about what's the best policy for the United States country and not for themselves. Financial institutions, it's really screwed up, and I hope that they've learned the lesson in terms of what happened in the reaction. I think some financial institutions should seriously consider whether they want to be in the consumer business at all. Banks, especially, were for many years commercial lenders. They didn't specialize in consumer products. I'm not sure that they are the best institutions to be in the consumer business going forward, or if they are, they have to have the kinds of ethics that would be discussed right here. And what was the third one?
Consumers.
Consumers, yes. Consumers, my advice would be, just because you can get a loan doesn't mean you should take it.
There you go. So any questions from the audience? Take one or two questions. It's over here.
Hi, good morning. My Rodriguez, Ben Counsel, Raymond. So Mr. Natter, you said that there haven't been enough years to have gone by to identify the causes of the too big to fail crisis. How much longer do you think we need, and how much longer before we, the banking industry can recommend policies that stop privatizing the gains and socializing the losses?
Well, first of all, I'm not a representative of the banking industry. So I can't speak for the banking industry, and I'm sure there are things I've said today that the banking industry would oppose. But let me give an example of what I'm talking about. I recently read a paper from the Boston Fed which talks about adjustable rate mortgages. The thought had been, and the conventional wisdom is that adjustable rate mortgages were a big problem because when the rates went up, people were tricked into getting loans at a low interest rate, and then they had a rate shock 2 years later, and then they weren't able to repay the loan. Well, the empirical data which is coming out now says that that is not factually what happened, that for many of the adjustable rate loans, there was no rate shock because when interest rates went down, there was no increase in their monthly payment. And if you look back over history, the past 15 years of the performance of adjustable rate mortgages, there is no correlation between, or very little correlation between adjustable rate mortgages and mortgages that defaulted. They defaulted without there being an increase in their interest rate. There's a lot of regulatory effort to, and ultimately didn't happen, but to ban or provide penalties for adjustable rate mortgages. It turns out that would have been an inappropriate reaction. And to the extent that it's a good product, and I think it can be a very good product for people who are moving or starting families with a starter home, it would have been a benefit, economic benefit for the population that could easily have been taken away. So that's just one example. We are beginning to get evidence. There's certainly having prudential standards, having better liquidity, and the right kind of liquidity, having better and more reasonable capital requirements, having stress tests. These are all things that make sense, no matter what the cause of the crisis. But we need to make sure that the actions we take are based on facts and not on conventional wisdom.
I'm sorry,
I know you
I
will.
can't contain myself.
I know you will.
So I think the industry, listen, there has been some industry sponsored research and other kind of, reinventing history, like creating fuzziness about what caused this crisis and whether that serves people's interests if they don't want reform. Let's create a lot of confusion about what the problems were, and then we don't know what the solutions should be. On the, there's adjustable rate and there's adjustable rate, and these toxic 228s and 327s defaulted at much higher rates than 30-year fixed-rate subprime mortgages. It's silly to suggest otherwise. And if you want research that does not necessarily reflect the industry view, I would suggest you go on the website of the Center for Responsible Lending. That's done a lot of work on this. And most certainly, yes, there was a significant size of the troubled mortgage market. They were flippers. They were professional investors. They were doing the low doc, no doc, relying on the mortgage applications, buying 3 or 4 houses. You betcha. That ugly stuff was out there. There were also a lot of people living in lower income neighborhoods who once had nice, safe 30-year fixed rate FHA mortgages who got refied into these 228s and 327s. And yes, the default rates were very, very high and much higher than the fixed rate subprime. So there are definitely two different perspectives on that.
I have to respond because I feel like my integrity.
Okay, did the industry have any responsibility for this crisis? Did they originate any bad? Well, this was just all the government forcing them to give poor people mortgages, or sophisticated borrowers ripping these investors off. Was it all the borrower's fault? I'm sorry, I've heard that so much. I heard that in 2006, 2007, 2008. I am still hearing it. Take some responsibility for this. We can't get it fixed until you start taking responsibility.
Just a reminder for those of you that we have time for a couple more questions.
Wait. This is a point of honor.
Or rebuttal, and then we're going to move to this nice gentleman in back.
I respect you, Shelia, and I think that you
1 in 5.
you are a heroine. You are a heroine. But what I'm a little troubled with is the reference to industry-sponsored research, because my research, Federal Reserve Bank of Boston, I don't think that's industry-sponsored research. It may be, and if it is, I retract all I say. But if you look at the empirical data that I've looked at, then I think you might want to. You might want to say, Ray,
you can just look at the default rates between adjustable rate and
I didn't talk about default rates. I talked about the interest rates.
You two take this discussion offline in the speaker's lounge after the fact. Gentleman in the back, question.
Yes. Eric Filipiak, Fifth Third Bank. Since we're at a symposium honoring the 150th anniversary of the OCC, I must ask this. Ms. Bair, in your book, one of your proposed reforms included abolishing the OCC. Though you expressed cautious optimism at the time, regarding the agency's future with Mr. Curry taking over as controller. Do you still espouse this proposal? If not, how has the OCC altered its behavior to cause you to change your mind? And are there any particular rules, guidelines, or other regulatory actions that you would point to as evidence of this improved and reformed behavior?
Right.
Thank you.
Well, look, I think my experience with the OCC was during the time which predated Tom Curry's tenure here. He was at the FDIC, on the FDIC board, was one of great frustration. There were a lot of disagreements, and I felt, as opposed to being a partner in trying to make sure these banks were stable, it was an impediment. I also think just having so many regulators can complicate supervisory response and rule writing. And so having a framework where you had the Fed basically as holding company regulator and the FDIC as regulator of the insured banks, and that, that would be a merged FDIC-OCC entity seems to me to make some sense. That said, it was done before Tom got here. I think Tom's made showed tremendous leadership here. I think OCC examiners are some of the best in the country. They really have been top notch. And I don't think the Congress is going to abolish OCC anytime soon. But let me tell you something else that I think would make OCC a stronger agency, which I think most of the OCC folks here would agree with, is dealing with their funding base. They have to rely on examination fees, which is difficult, especially as the industry has become more and more concentrated. The Fed and the FDIC have the advantage of having separate funding sources from institution-specific fees. And so trying to figure out a new structure where there's some combination of shared Fed FDIC funding for the OCC, I think would make it an even stronger and more independent agency. And that's something that I would hope would be in the short term doable. But I do want to compliment Tom. I think he's done tremendous work here. And I had agreements with OCC too, including the past leadership. And I do think the examiners are some of the best and most sophisticated among the regulatory community. That said, I found, as I chronicled in my book, that frequently, unfortunately, the OCC I felt was an impediment, not a partner in trying to get these problems fixed.
All right, last question, gentleman in back.
Jose Gabilondo, Florida International University. Thank you for a great panel. My question is about the bank funding model. Banks are supposed to be illiquid. They're illiquid by design, I always thought, because they borrow short and lend and trade long. But if you look at a lot of the regulatory proposals, the liquidity coverage ratio, which requires more liquid, shorter duration assets, the net stable funding ratio, whose status is unclear, but Governor Tarullo makes noises about getting U.S. banks to issue longer-term debt. It seems like, are regulators suggesting that the borrow short, lend long model is no longer tenable, or the banks can't really do that anymore, or in the same way?
Well, I think
If that's what they're doing, they're in for a surprise.
Mm-hmm. Yeah, I think the issue is non-deposit funding and your debt financing, and whether that's short or long term. And yeah, there was way too much reliance on the repo and commercial paper market, and that was an increasing portion of the liability structures in these larger institutions, which was quite unstable. So I think in terms of the non-deposit component of the funding base, forcing them to issue more long-term debt is good, and that will also have the indirect effect of making the uninsured deposits more stable, because you'll have a thicker level of long-term unsecured debt to serve, in addition to the capital if the institution fails, to protect the uninsured depositors, which should make that funding more stable. So I absolutely strongly support Governor Tarullo. I think that is the right direction to go, but I think you need to distinguish between deposit and non-deposit funding in analyzing what he's talking about.
You're changing the nature of banking, which is what is happening. We're changing how banks are regulated, how banks are funded. That is going to result in different impacts on the economy. So as a general matter, I'm not saying it's not appropriate, but there's no free lunch. There's going to be higher costs for borrowing, higher costs for credit. Maybe that's good, but it's going to be an impact. I don't think it's good, but it's going to be an impact. So we can have that model, but it's not free.
Excellent. Well, I'd like to thank each of the panelists.
Yeah,
thank you
you.
so much.
Yeah,